This interview with Marlo Oaks, the Utah State Treasurer, is the first in a series of episodes that we're going to be doing on ESG, environmental, social, and corporate governance. I've held off on this for quite some time to really go into this. It is much more pernicious and pervasive than you might imagine, and it's very concerning as it makes its way into the capital markets, into our K-12 schools as well, and in the fabric of the institutions within the United States. Already at over 40% of assets under management are under some type of an ESG framework. You're going to learn a little bit more about that in this episode, which is brought to you by Cardio Miracle. Cardio Miracle is a supplement that I use every single day. It has made changes that I can actually measure by lab and by my own monitoring, physical device monitoring that has really made an impact and given me many benefits. And if you want to find out why I use that every day, then you can go to cwicmedia.com, CWICmedia.com, scroll down in the front page there, watch the video, and go to the link. And if you're interested in trying the product, it is a 60-day money-back guarantee. And through my website, you're able to get a 15% discount. I believe in this stuff, in the nitric oxide. You should try it out, at least take a look at why I use it every day. All right. One additional item here by way of introduction. Marlo Oaks is one of the good guys. There are, honestly, very few politicians that I even get to know a little bit where I don't feel that there's a real lack of authenticity. Marlo is principle-based and is someone that you should listen to. He is doing what he's doing, fighting against ESG because he sees the dangers on this and not just for political reasons. Take a listen. I think you'll enjoy it. All right, welcome to Cwic Show. My name is Greg Mattson. I am your host. My guest today is Marlo Oaks. He is the state treasurer for the state of Utah. We're going to talk about ESG. Marlo was one of the first state treasurers to pull funds from the world's largest asset manager, Blackrock, due to their ESG policies. Most of the listeners, Marlo, know what ESG is here on this podcast. Can you just kind of go over just a brief idea of what ESG is and what it does?
Sure. Yeah, so ESG stands for environmental, social, and governance. And I just summarize it really as a political score that measures compliance to a political agenda. And I should probably say it's more of like an investment score, but it essentially measures compliance to an agenda, and it's being pushed in the capital markets or with companies that are operating in the capital markets. So it has to do with investors that provide capital to companies. And so it's a way to signal to investors how compliant a company is relative to these ESG factors that have been identified.
So, that seems to one degree, I don't know, I've been in I ran a wealth management firm for a while. Having the transparency, for example, from an investor side to say, okay, well, is this a company I want to invest in? There's a score here. There's going to be more disclosure on, maybe it's an important thing to me that I look at green investing or social investing. That doesn't seem to me to be the issue so much, right? Is the transparency with the companies. That might have some influence, but
yeah,
is there really a problem on the investor side? Let's talk about the individual investors or even institutional investors in learning more about the transparency of certain companies and asset managers.
Yeah, so transparency is a tricky thing because it depends on the kind of transparency that we're talking about. So oftentimes the transparency that is requested is political in nature. So when we talk about diversity, we're not talking about diversity of ideas or ideological diversity. we're talking about diversity of demographic characteristics, sexual orientation, things of that nature. We're not talking about veterans, other criteria. It's a very narrow band of transparency. When we're talking about wanting transparency on political contributions, what is often the agenda there is to cut off capital to conservative organizations. So transparency is a buzzword that is used really as a weapon to drive an agenda to silence another side. And so people have to be very, very careful when they talk about some of these issues, because it's all in how it is applied. And that's part of the problem. Now, if we talk about investors wanting information, really the challenge I see with ESG isn't with the individual who feels strongly about these particular issues that are embedded in ESG. It's really about larger institutions like the Blackrocks, the Vanguards, the State Streets of the world that are using their entire book of business. So in BlackRock's case, they've got $8.5 trillion. Whether those investors, all of them, have an ESG mandate or not, they are essentially going into the marketplace and engaging with corporate America to drive a political agenda. And they do it through what's called their stewardship group. The stewardship group is 70 analysts that engage with corporate America on these different issues, and they vote proxies in the companies. And because they are indexed, a lot of the money is indexed or passively managed. They use the proxy to vote out directors who are not sufficiently committed to the climate agenda, or if a company is not pushing the social elements that they favor, then they'll vote the proxies to push that. Things like racial equity audits or pay equity or things of that nature, diversity, equity, and inclusion. So it manifests itself in different ways. But the way I explain it to investors is that you can think of socially responsible investing as something that's been around for centuries. The idea that as a values-based investor, I may choose not to invest in certain companies because of my values. But I respect the values that other investors have that may be different from my own. And ESG really is an aggressive form of socially responsible investing, because the ESG engages with the markets, engages with companies to change them. So, for example, if I'm invested in ExxonMobil, my investment thesis likely revolves around the importance of oil and gas. And so I want to have exposure to oil and gas in my portfolio, and therefore I invest in ExxonMobil. What I'm not expecting is for a company like BlackRock to go into ExxonMobil and, with the power of their shares that they own through their indexes, tell ExxonMobil to reduce oil production by 20%. That affects my investment and every other investor's investment and impacts the marketplace, and is fundamentally anti-capitalist in nature. So it's very problematic, and it's not like traditional socially responsible investing.
So you're looking at it really from the top down, right? It's the bottom up, where you have investors that have transparency, is not the issue. The issue is really the control, the centralized control of manipulating markets through ESG, through environmental, social, and corporate governance. That is really at the whim. I've been watching CNBC on this lately, and you've got the push really is the sell is the transparency to the investor, but they're trying to move this to a centralized, because there are different ESG scores, different types of ESG scores that different institutional investors use. but they're trying to centralize this with the ISSB, which is out of UK. There are 22 oversight managers, trustees, with 8 of them underneath them. And they decide, it's an accounting firm, essentially. And they are going to decide what the ESG score is going to be. They're going to centralize it so that everybody can be on the same page. Now, you've brought up before an example of how that top-down manipulation might happen, even there in the state of Utah. In other words, how are you, because banks would be involved in this also, how would you be able to, how would one state differ from another in terms of borrowing money and how an interest rate might be affected through an ESG score?
Yeah, so I've talked for months about how Utah has the best credit in the world. We trade essentially like treasuries do in the taxable market. We trade like treasuries in the municipal market, which is to say that we trade at the lowest rates in the marketplace. So we borrow money at the lowest cost in the marketplace, which allows us to borrow money and make it less expensive for taxpayers in the state of Utah. And the reason for that is that Utah has very strong credit. We've never been rated below AAA, which is the highest credit rating. But if we have something other than a credit rating assigned to the state, then that can be used as a reason not to allow Utah to borrow at the lowest rates in the marketplace. So, for example, if we have a separate ESG score, that ESG score is taking into account things that are not necessarily financially material. Now, when S&P Global came out with their ratings on states, the one area that they pointed to in the state of Utah was drought. And I maintain that if drought is a financially material issue, and it very well could be, that should be part of the credit rating of the state, not a separate score. Because when you introduce a separate score, like under the social part, one of the factors, and they didn't provide a rating on this, but one of the factors is adverse publicity resulting in reputational risk. So there was a volleyball game at Brigham Young University at the end of August. And that was a perfect example of adverse publicity resulting in reputational risk, where one person was accused of hurling racial slurs at an opponent. And let's say that incident actually happened. Let's just assume for a minute. Now, there wasn't evidence that it did, but even if it did, one person has now been accused of something that paints the entire state with this brush of racist. We're a bunch of racists in our state, and therefore we should not be given the lowest rates in the capital markets to borrow money. How does that have anything to do with our ability to repay money? First of all, and second of all, why is it an issue with one person that has harmed the state potentially? I mean, to me, it just illustrates the political nature of this and the problem that this creates. Because who's deciding what is reputational risk? Which newspaper is creating the adverse publicity? Because as we know, that it all depends on how you write the story. And so
Sure.
To me, it illustrates the problem of how you can insert an outside entity like S&P Global to drive a political agenda that really has nothing to do with investors getting paid back.
And all these institutional S&P and Blackrock and State Street, they all seem to be on board with this.
Yes.
It's very concerning to me. I mean, we have already, based on their numbers, there's over 40% of assets in the United States are already under some type of an ESG scoring system. They run a report every couple of years, a global report every couple of years. They had a 15% increase from year after year from 2 years ago. Interestingly, this year, they're down 40% in ESG investing because of the markets. So the market showing what's happening is saying, wait a minute, ESG is nice, but when the rubber hits the road, maybe an investor doesn't actually want to lose money based on an ESG investment, right? And having a higher score. Well, but with all of this, it's kind of like a cabal to some degree. I mean, if you have all of the major institutions that are combining in on, especially on a centralized score, that to me is complete control over the market. There's no way, and it opens up not only a political agenda that can be driven down through the markets, but mass corruption. Really, the ability to corrupt something to overthrow the rules, the natural laws of a marketplace, just seems like a really bad idea.
Well, and you think about socially responsible investing, if that's the starting point, socially responsible investing where I respect other people to have different values from my own, ESG cannot be successful under a socially responsible framework, because that still respects the capital markets and the ability for other firms to act differently. That's why ESG is so pernicious, is because to be successful, you have to have a significant amount of capital to drive an agenda. And that's where what you're observing is exactly correct. The people who are pushing this agenda went around, for example, John Kerry went around to the banks in 2021, the largest banks in this country, and signed them up to commit to net zero emissions. The largest asset owners in this country, the largest investment managers, the people that have the money, if they all decide on this one agenda, this future, something that's going to happen in the future, and they all say, yes, this is going to happen, therefore we all need to do X, Y, and Z, then you've essentially destroyed a market. Because in a traditional capital market, if JP Morgan, for example, decided not to provide capital to a certain entity, a Bank of America would, because they see the business opportunity. When you capture the entire marketplace, or at least the largest players in the marketplace, then you can drive a political agenda and keep capital from moving where it otherwise would move. And so this undermines our capital market system. And you think about centralized control and monarchical systems. We got away from those systems when we left Europe, because we wanted to have a pluralistic society, pluralistic institutions. Our Constitution is made up of 3 branches of government with checks and balances. Our our marketplace of ideas, the public square, where all of us have an opportunity to debate ideas and come up with the best solutions. That's a pluralistic institution. The marketplace of financial products is a pluralistic institution where capital moves around and funds different projects. That is the greatest driver of innovation in world history. That is a critical pluralistic institution. ESG destroys all of those things, because you are driving a centralized political system. And so I tell people this is potentially the greatest threat to our freedoms in our lifetime, because it undermines the Constitution of the United States, and it undermines our free market capitalist system. It undermines the public square of ideas and debate.
And I think for those that may not have looked enough into ESG and researched that, they should take a closer look, because a lot of what the pushback is this is some type of a global conspiracy theory, but it is very, very real. It is happening at a pretty fast rate right now. And again, the concern is the overriding of the market. Take, for example, let's say that there are more and more assets. I mean, we're under 50% right now, but there's more and more assets in the U.S. that go under the ESG umbrella, and we start getting to 50, 60%. So there's at some point, there is a tipping point here where what becomes important is not the viability of the investment itself, but the score. And therefore, the drivers for investors, if you have a company that might take a little bit more risk somewhere, but they might have a greater return, or they're in, oil, as you said, people are going to start jumping out of it if the ESG score becomes the most important thing. and that seems to me to be the goal, because if I have a company, I'm going to be looking not just as a value investor. In other words, I'm looking for value in the stock. I'm going to be looking at the ESG score instead.
Yeah.
Right? Or if I'm looking for a growth stock and potential there, that doesn't matter. What matters is, what is the ESG score going to be, which is going to be based, as you said, on how have they put in DEI and officers into the company, what investments and initiatives do they have globally with both social and environmental issues. But if that were to move to a tipping point where an investor simply says, I can't worry about this over here, even though this looks like a great deal, because if the ESG score is not going to be where it needs to be, other investors are going to go to the ESG score more and more as the indicator of what company should be invested in. And that's going to, of course, drive every decision by companies and anything within a sector.
Yeah, and then you have the proxy voting, right? That drives what's done at corporations. That's really the politicization of the kind of the democratic process within corporate America. And you think about high scores, high ESG scores. This last summer is a perfect example of why this is really not helpful. When Sri Lanka had the highest ESG score of any country, and yet as a result of that score, to get that score, they got rid of nitrogen fertilizer and went to organic fertilizer, which led to lower crop production, which led to higher food prices, which led to the civil unrest because of hunger and food insecurity. And the people basically overthrew the government. That is tremendous risk. People talk about ESG risk. Well, we're talking about civil unrest risk, right? I mean, there's a lot of risk when you move into a market and distort the marketplace and say, well, capital should go here because they've got great ESG policies that ultimately result in civil unrest because of lack of food. So you're clearly seeing the impact, the negative impact of driving capital based on ESG scores. An early example is the financial crisis in the United States. In the name of social justice, banks were strong-armed to provide capital to people to buy homes because it was an American right to buy a home. So too much capital ended up moving into the housing space, and we saw what happened there. Almost the entire collapse of our system. So this is very problematic when you begin to distort markets based on things other than economic factors.
Now, Marlo, you've had you pulled the money out of Blackrock, the largest asset manager in the world. Other state treasurers have done the same. Louisiana has announced, or I don't know if they've gone through it at this point already, but they've got over $700 billion or $700 million that they are pulling. Here you go, $794 million out of BlackRock funds. This was announced on October 5th. You're involved with going around and talking with other state treasurers, I believe, about ESG and how they ought to look at this and the concerns that they might have in looking at this scoring system. Is there success in that? Do you see a tide, at least on some states, where they may be pulling more and more out of these BlackRock and perhaps other institutional investor funds?
Yeah, I think for at least in the case of folks that I've talked to, the concern is really the politicization of our capital markets, and it's the dual mandate that ends up happening when you have an investment manager like BlackRock that has these stewardship groups. They have adopted essentially a dual mandate, which one is political and the other one is to drive economic returns. But those are conflicting. And so when you have a dual mandate, you can't fulfill your fiduciary obligation because one is vying for attention over the other. You're basically in a conflicted position. And so that's the problem. It's not that we're trying to fight against, climate change or whatever the issues are. I would be just as against this if companies were forced to make pro-life contributions, because you're still politicizing the capital markets. And so it's our fiduciary obligation that really motivates us to look at firms like Blackrock, Vanguard, and State Street that have these underlying stewardship groups or that are pushing an agenda. That's where it becomes problematic. And I think people in the marketplace are waking up to this, including other state treasurers. And so I really make an effort to speak to as many people as I can, because I believe it is harmful to all of us and not in our long-term best interest, which is interesting because the long-term best interest is what these groups use as their reason, the justification, right? They couch it in terms of economic benefit and the reason for them driving this agenda. But there's so many problems with that. As an investor, I have to look at, of course, long-term risks. But I can't be 100% certain that an outcome is going to happen. And so putting all of my eggs in one basket, so to speak, and pushing ESG, which is kind of that, this push to decarbonization or other things. It's hard. You can't do that knowing that that's absolutely the problem and going to fix the problem. There are other issues that can create. And so as an investor, you have to take all sorts of things into account. And who's to say those are the most risky things? Why not China relative to Taiwan and geopolitical risks with Russia that, the result of Russia invading Ukraine? You can see the problems that Europe's energy policies, driven a lot by ESG, look at where they're at now. So these things, investing is very complicated, and to boil it down to ESG factors, I think is an oversimplification and causes you to potentially lose sight of other risks that could result from driving one political agenda.
Yeah. I'm looking here. You talk about those other influences. The ISSB, which is this governing board of 8 individuals underneath 22 others. It's the IFRS. It's over that. They're out of the UK. But they've established a jurisdictional working group made up of, and the first one is the Chinese Ministry of Finance.
Oh my goodness!
Right, that is in there. The European Commission, the European Financial Reporting Advisory Group, and the UK, Japan. They've got some others in there. But you can see this becomes kind of this global political agenda. I mean, how can it not be? If ESG is driving everything, then the political powers and economic powers globally are going to want to have their hands in this. They're not thinking about the individuals. They're not thinking about the investors. They're thinking about what their political agendas are. And centralizing that control under ESG, it just seems to me that certain companies will be put and in investment avenues will be put into a completely different class. It's like creating a new class of company and investment for investors that is, it's kind of blackballing, if you will, all of the other companies that are not going to follow suit. I'll give you an example. I mean, let's look at this in a social example. If you had a large public company that had a certain ESG score and they're not up to task, so to speak, on the number of minorities that are hired or the number of women that are hired in higher management. They're not taking on initiatives in growing their company that would, you name it. I mean, they're not focused enough on lowering the pay wage gap, if you believe in that, in between men and women or whatever else it might be. If they don't follow suit, then what happens, right? What happens is BlackRock then all of a sudden say, we're going to remove you from all of our index funds.
Well, it's usually going to be, we're going to remove the directors because they don't have the ability really to remove them from the underlying investment from an index.
What about loaning money, though?
Loaning money, yes. But you know, the I guess the weapon or the threat is really to management to replace them with directors that will toe the line. And it does have a feel of oppressors and oppressed, right? If you're towing the line, you're one of the oppressed, you're one of the good people. If you're not, you're an oppressor because you're not going along with the agenda, which, you know, those words come out of Mao's Cultural Revolution. And so absolutely.
That is not a stretch. It's not a stretch.
No, it's not a stretch. You think about Tesla being kicked out of the S&P ESG index. I mean, what better example do you need of how political this is, right?
Yes. Yeah, that's something. It's ironic, very ironic.
Absolutely.
You know, one thing on the end of financial advisors also, because I've been in that world for a while, is, you know, you imagine also what they're also doing is they're trying to say, especially like I know BlackRock has done this and others, where you have got to get people into certain funds, you've got to, at a certain level, you have to have disclosures given to the investor. And so the end investor, all of a sudden, the financial advisor, in order to say, where are you going to invest, or this is where I think you should invest, and you come up with a plan for someone, their retirement, let's say their retirement plan, you have to come out with disclosures that say, if you invest in this fund over here or in this company or whatever it might be, then you need to realize the ESG score is down here. And if it's down here because of this reason and this reason and this reason, maybe you should consider something else. It's pulling the strings from a very small group of people that's going to affect the entire hierarchy structure of the investment in capital markets.
Well, and I would say that the problem with the Vanguards, the Blackrocks, the State Streets is that as a financial advisor, if you're putting capital with any of those entities, you're likely not putting your clients in an ESG labeled product, but that doesn't matter because the companies are using the entire power of their asset base to drive the agenda through these stewardship groups. So it won't be labeled ESG necessarily. You're probably going to choose an index product. And if you choose an index product, that goes into their pool of capital. And then their stewardship group is going into corporate America and saying, here's what you need to do, corporate America. They're not even looking at ESG scores. That's not even relevant necessarily. But they are going in, like the example I gave earlier, ExxonMobil, you need to cut oil production by 20%. So your client and you may not even realize that the money that you have placed with that firm has been politicized, but it's being politicized in the back door. It's not at the front door. It's not a label that's being put on the product that you're in. That's one of the biggest reasons why this is so problematic. In pension plans, large pension plans that have placed money with these investment managers, the underlying beneficiary may not want to be in BlackRock, but they don't have the power to pull the money out because it's the allocator, the pension sponsor, that is making that decision for the underlying beneficiary. And that's the problem, the fiduciary problem that we have in this country, because not all beneficiaries agree with the political agenda. And as a fiduciary, my obligation is to the beneficiary and their economic well-being, not a political agenda.
Yeah, it twists everything. Marlo, you were running for re-election for the state treasurer in the state of Utah. I know a lot of people who have contacted me, wanted me to get you on. They're very high on you and for your future as well. How is the campaign going now?
It's going well. I have been invited to speak at a lot of places, and really appreciate the opportunity to get out and share message with people. And there's a lot of enthusiasm, around fighting this, because people are starting to wake up. They're starting to recognize the threat that this poses to our entire system. And that's why I think people are concerned about this. And so I appreciate the interest. I appreciate the support. And I will continue to, raise my voice against this, because I believe it really is the greatest threat that we face to our freedoms in our lifetime.
Well, what you're doing is really important. You're taking a stand, you're making a move, and you've got some sway. And I know that other state treasurers are following suit as well. So it's great leadership on that end. Appreciate your time, Marlo. Marlo Oaks, running for state treasurer in the state of Utah. Take a look at what he's doing. It's courageous, it's important, it's principle-based. And if you haven't looked at ESG, look at what it is doing and the threat that it really is to our American way of life.
And people can go to marlooaks.com, MarloOaks.com. There's a section on that website that talks about ESG. Stop ESG. If you go to that part of the website, you'll see articles. You can pull up articles and interviews that I've done, and it'll help provide background information to you. So to the extent that that's helpful, I would encourage people to go there.
Great. Will do. Thanks, Marlo. Appreciate your time.
Thanks, Greg.